Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
So what we're going to talk about today is disability. We're going to talk about insurance again, and the next one is income disability. So what is the difference between capital disability and income disability? So capital disability that we spoke about last time pays a lump sum or a capital amount in the event that you become permanently disabled or permanently impaired. So permanency is a very important factor in capital disability. Income disability pays out in the event that on a temporary or permanent basis you lose your ability to generate an income. So income disability is all about replacing the income that you have lost. Now that is a very important thing to understand as well, because I've got a lot of people that ask me with COVID, but can't I claim on my income disability because my company has closed down for 3 months and I'm not getting paid. So why can't I claim on my income protector? So income protector is not a retrenchment protector. So it doesn't pay you for retrenchment or if you lose your job or your income. It is covering your income in the event that you cannot generate an income as a result of an accident or an illness. So it has to be as a result of an accident or an illness before you can claim on your income protection. So in the income protection, there's two parts to it. There's your temporary income protection and your permanent income protection. Your temporary income protection will pay you if you cannot work for a specific period of time, but chances are you're going to get back to work. You're going to recover. So let's take an example. Let's say you got into a car accident, you are in hospital, and you are going to be in traction for 6 months. So what will happen is after your initial waiting period, the income protection will start replacing the income that you've lost. And I'll talk about the loss of income now. And it will replace that income until such time as you are recovered and can get back to work. If you then get back to work after 6 months, your income will start coming in again. Your income protection will stop and you will be covered again from there. Let's say it becomes so bad that you can never ever get back to work and start an income. Then after 24 months, usually 24 months, there are different terms, but usually it's a 24-month period. After 24 months, your permanent income protection will start paying you that income until such time as what your cover ceases. So that is another thing we need to look at is the term on that. So you get different terms on these income protection. You get income protection that gives you a term up to age 60. So at age 60, your income protection payments will cease, which means you will have to have made provision for your retirement to take your retirement money and start funding your income from 60 onwards. You have income protection that only ceases at age 65. So again, the payments cease at 65 and then you have to continue with your pension. So the fact that you have become disabled and now claiming income protection doesn't mean you can stop planning for your retirement. That still has to keep going. Then you have a term until age 70. Same thing applies. And then you have a new thing that's been around for the last couple of years, which is whole of life income protection. Now, almost like with a medical aid where they say 100% cover isn't really 100% cover, it's just 100% of medical aid rates. So the doctor can charge 200 or 300% of medical aid rates. So 100% doesn't always mean 100%. Just in the same manner, whole of life income protection doesn't really mean whole of life in all aspects. It means for the rest of your life, you will qualify for an amount of income. So how it typically works is one of two ways. Your income protection will keep paying until you are 70 years old. And then at 70, they will look at a different kind of definition. They then don't look at whether you cannot earn an income anymore, because in their minds, you are now retired. And as a retired person, you cannot claim for a loss of income. So they will then start looking at impairment definitions. And impairment covers you as a person. not your occupation or your income. So if you are then defined or declared to be 100% impaired, it will keep paying that income for the rest of your life until you pass away. So it will either pay a limited amount, some companies only pay out a maximum of 30,000, or it will pay out a percentage of that amount for the rest of your life. Some companies pay 50, 55 or 60% of that income as a pension for the rest of your life. So whole of life is not, if you get a 40,000 Rand income protection, you're going to get 40,000 Rand growing with inflation until the day you die, if it says whole of life. At 70, those definitions change. Now, one thing that you need to understand is that income disability doesn't insure the income, so you either get the whole income or you get nothing. It is an income replacement benefit. What that means is that it replaces any income that you have lost as a result of your accident or your illness. So the fact that you got into a car accident doesn't mean you qualify for a 40,000 Rand income protection benefit if your company is still paying your salary. So while your company is still paying your salary, you won't be able to claim from your income protection because you haven't lost income yet. So you have to prove loss of income before you can claim on your income disability. Another thing that is important is that you won't be able to claim income disability if you have been retrenched or you are unemployed at that stage. So if you are unemployed, you get into a car accident, you cannot claim for income disability because you have no income that needs to be replaced. So just keep that in mind. I'm not saying cancel your income protection if you lose your job. I'm saying have a look at it and make sure if you have a plan that you're going to get employment soon, just keep it in place. I have spoken about COVID. There are certain limits to income disability. You are not allowed to be better off disabled than you are working. So in the past, what happened is your income protection, the premiums that you were paying for it was tax deductible. So you could, at the end of the year, claim back those premiums from tax and get a refund. They've now changed that so that the premiums are no longer tax deductible. But the difference it makes is in the past, when the premiums were tax deductible, your benefit was taxable. So if you got 10,000 Rand income every month from your income protection, you would be taxed on that 10,000 Rand. Now it is after tax. So because you can't claim back your premiums anymore, the amount that you get is tax-free. So if your income benefit says 10,000 Rand, you will be paid 10,000 Rand into your account. So it becomes completely tax-free. But there are limits. Like I said, you can't be better off disabled than you are working. So you are allowed 100% of your after-tax income within the first 24 months. So what that means is if you are earning 30,000 Rand a month and you're paying 5,000 Rand tax, 25,000 is your after-tax income, and that is the amount that you can claim on a temporary basis. On a permanent basis, you're not allowed more than 75% of your after-tax income. So if you take that 25,000 times 75%, that is the maximum that you will qualify for on income protection. You might be able to get more cover, but once you go into claim stage, you would have been paying for cover that you can't get. And this is extremely important. You have to take into account the benefits you have at your group scheme as well. Guys, I see it so often that financial advisors do risk cover for people, but they don't even look at their group scheme. They don't look at their group life, their group disability cover. And then the client he's paying for income protection in his personal capacity, but he's already getting 75% income protection on his group scheme. So therefore, he's not going to be able to claim on both. So he's going to be paying for a benefit that he will never be able to receive. So always make sure that when you sit with your advisor, that they actually look at your group scheme and take that into account as well. For self-employed individuals and business owners, you must always remember is when you take out income protection, once you are in claim, you're going to have to be able to prove the income that you have lost. So it is important to prove that you are what your income is, that you are earning in your personal capacity, and make sure that you have your financials ready, your tax returns are up to date. They look at all of these different things to prove the income that you've lost. You can't just say, I'm losing 40,000 Rand per month. You have to prove that you have lost that income. Another thing that is very important to look at is two things. The first one is your initial waiting period. So what I see a lot of times is people try and come and sell you something that is cheaper than what you were paying before, but what they do is they extend the initial waiting period. So with the income protection, your temporary income protection, you've got different waiting periods. You've got a 7-day waiting period. You've got, some companies give you a 14-day waiting period. Some it's a 30-day waiting period. Some is a 90-day or a 3-month waiting period. You can do a 6-month waiting period or even a 12-month waiting period. Now, obviously, the longer that initial waiting period, the lower your premiums will be, because the risk for the insurance company that they will have to pay out that claim that you're going to claim from them is lower the longer the waiting period is. So what I see happen often is the financial advisor comes, he tells you that he can get you the income protection for cheaper, but all they've done is they've moved it from a 1 month or a 7-day waiting period to a 3-month waiting period. So just be careful. Saying that, there's nothing wrong with the 3-month waiting period if you know you have enough sick leave and your company will be willing to cover you for that period, so you're not going to lose income in that period. So let's just quickly talk about the waiting periods. When you look at a 7-day waiting period, what happens is this is usually for business owners, self-employed individuals, which immediately loses their stream of income if they can't work. So how 7-day waiting period works is if you cannot work for more than 7 days, it will backdate all the way to day 1 and start paying you that loss of income from day 1 onwards. If you have a 30-day waiting period or a 3-month waiting period, it will take that 30 days. If you can't work for 30 days, from day 31, it will start paying you. So if you don't work for 40 days, it will only pay you 10 days worth of income protection if you are on a 30-day waiting period. Where if you can't work for 40 days and you are on a 7-day waiting period, it will pay you for 40 days worth of income protection. So the 7 days for self-employed individuals is better cover, but it is quite a bit more expensive. So again, that gets manipulated to show people that they get the cover cheaper with one company over another company, and actually they're just manipulating the benefit. The other thing that you have to put in place is your income protection has to increase every year in claim. Because think about it, if you're getting 30,000 Rand a month, you become disabled. In 10 years' time, that 30,000 will only be worth about 15,000. So you're basically, with inflation, going to get less and less and less a month. So you have to keep that increasing every year so you can keep track with inflation. So just make sure that your income protection does have an escalation in claim on. So Warren asked a question. He says, "Hi Lourens, when converting from group cover to individual cover, can one expect a dramatic cost increase in like-for-like cover?" So Warren, how that usually works is it's not a clear-cut yes or no answer, because it depends on your specific medical and age rating. So how it typically works is a group cover has a free cover limit. So anybody in that group can get cover at that rate. So whether a person is 20 years old or a person is 60 years old, the rate that they pay for their risk cover is exactly the same. So what that means is that what would typically happen is that the person who is younger, who is a lower risk, will pay more on their group cover than they would if they take out that exact same cover in their personal capacity. A person who is older, who is a higher risk, will pay less on their group cover than they would in their personal capacity. So it all depends on where you are. If you are sort of in the middle, you are probably going to pay very much the same whether you are on your group cover or whether you are in your personal capacity. But once you get a little bit older, then if you then move from group cover to personal, it will be more expensive. And if you are young, like 20s, 30s, you are probably going to pay more on your group cover than you would on your personal cover. So I hope that answers your question. Okay, so the next area we're going to chat about a little bit is severe illness. So severe illness, there's a lot of different names: severe illness, dreaded disease cover, all of those kind of things. So severe illness is cover for all those illnesses that could create a massive financial strain on you. So severe illness are things like cancer, strokes, heart attacks, diabetes, those kind of severe illnesses that you can get. Now, what I get asked a lot when we look at severe illness cover is people ask me, but isn't it the same things being covered over and over again? I mean, I have a medical aid. I am covered for disability. Why would I need severe illness cover as well? So to understand that, and how I explain it to people, is severe illness falls in between where the others don't reach. If you look at the three main things that could happen to you as a person, you could pass away, you can become disabled, or you can have a major medical expense or hospitalization. Severe illness fills the gap in the middle, because something like cancer, which is the most well-known severe illness, cancer and heart attack, if something like that happens to you, you won't necessarily pass away so that your life cover pays out. You're not necessarily going to be determined to be disabled so that your disability pays out. And your medical aid will pay for some of the expenses, but usually not for all of the expenses related to that illness. So it fills the gap almost like a seal in the middle to make sure that it doesn't matter what happens to you, there is something that's going to look after you financially. Now, how I explain it to people is the difference between severe illness cover and disability cover, because a lot of people battle to get their head around that one. So severe illness covers you on the diagnosis of a specific severe illness. So for example, you get diagnosed with cancer. Your severe illness on the diagnosis pays out to cover the medical expenses for that. Disability pays you on the permanent effects of that illness on your life. So when you cannot work anymore because of your cancer, because you are getting treatment or whatever the case may be, your income protection and the disability will start kicking in and covering you for the permanency of that, of the effect of that illness. So it's not covering the same thing. The severe illness covers on diagnosis, disability covers on the permanency of the effects of that on your life and your ability to generate an income. So when you look at severe illness, you must always look at getting standalone severe illness cover and not accelerated severe illness cover. So let me explain quickly. I did last week talk about accelerated benefits against standalone benefits, but I'll quickly explain it again. So if you look at an accelerated benefit, let's say you've got R1 million life cover, you've got 500,000 rands worth of severe illness, and it's an accelerated benefit. That means that if the dread disease cover pays out, it accelerates your death benefit. So it pays your death benefit before you actually dies, which means your death benefit will reduce from R1 million to 500,000 rand. If you have standalone benefits, the one doesn't accelerate the other one. So if you get a dread disease, the 500,000 will pay out, but the R1 million life cover will still be a R1 million life cover. So it won't affect the life cover. The second thing is, if you have standalone dread disease cover, your dread disease cover will reinstate itself. Where if you have an accelerated benefit, it doesn't reinstate itself. So what then happens is that on the dread disease, if you get a cancer payout, it pays out the whole 500,000. It reinstates back to 500,000. And if you then get a cancer or a stroke or a heart attack, it will again pay out 500,000 for one of the other eventualities that happen. So standalone dread disease cover is definitely better than accelerated dread disease cover. And then also preferably always get your dread disease cover as whole of life dread disease cover, because you get a lot of times when the dread disease cover is only covering you until age 65. So you've paid these premiums all your life until 65, when your chances of getting the dread disease is very slim. And then when you get over 65, when your risk of getting a dread disease becomes higher and higher, you don't have cover anymore. So you would always want to have that as whole of life cover, so that for as long as you pay the premiums, if one of these dread diseases do happen, it is paid out and you are covered for that. So what I want to talk about now is a few generalities that people don't always understand with life insurance. The first one is, but what happens when I move from one company, my life insurance, I move it from one company to another company? Am I not losing out? Am I not losing the premiums that I'm paying into the life insurance? Am I not going to be have all these exclusions, so I can't claim immediately? So what happens? So life insurance in that sense is very similar to when you look at short-term insurance with your car and household, where you can be insured with one company until the 1st of August or the 31st of July or 30th of July, and then from the 1st of August you are then covered from another company. So all that happens is the one company stops taking the risk and the other company takes over. One of the things that do happen with moving your life insurance to another company is when you start a new life insurance policy, you will have a new 2-year exclusion clause for suicides. So if you start any new life cover, there's always a 2-year exclusion clause on suicide. So what that means is if you commit suicide in the first 2 years of the life of that policy, there will be no claim, there will be no payout. If you commit suicide after 2 years, there will be a payout. And that's something that a lot of people don't know. They think that suicide is automatically excluded for life. So after 2 years, you are covered. But what they would do is they would take 2 years off the life of the policy. So as your policy increases over time, so let's say you are sitting here now and your policy has 1 million life cover. In 2 years from now, your policy has increased to 1.5 million life cover. If you then commit suicide, they will go back 2 years, look at what your policy looked like 2 years ago, and then pay out whatever the life cover was there. So they will only pay out 1 million of the 1.5 million after the 2 years. So if that doesn't matter how long that policy has been running, if it's been running for 30 years, they will go back to year 28 and say what was the cover on the policy at year 28 and pay that out if it is a suicide. Other than that, most of the covers, if they have given you the cover, the new company, they have approved it, you will be immediately covered. So if you go and you move your insurance from the one company, from company A to company B from the 1st of August, and the 2nd of August you get into a massive car accident and you are in hospital and you have to claim for temporary income protection, that company, the new company, will honor that claim. It's not like you have to be with them for a specific period of time. What you must realize, and this is something that people must it's just the practicality of it, is if you do have a cancer claim or some kind of claim immediately or very quickly after you've moved, there will be more of an investigation by the new company, asking more questions to make sure that there wasn't any pre-existing conditions that wasn't declared or there wasn't any non-disclosure happening. So they will ask more questions, because you can just think about it. They just got you on as a client, and immediately after you're on, you have a claim. They have to do that investigation. What will typically happen is if you decide to apply with a new company, the application will go in. They will then do medical underwriting. That medical underwriting will be blood tests, doctor's reports, whatever the insurance company asks. And then once they have done that, they will come back with an answer, and it will be either a best case scenario, worst case scenario, or something in the middle. Best case scenario, the new insurance companies say, listen, we will accept this cover exactly as is, and then you just move from the one to the other one at the end of that month. Worst case scenario is they say to you, listen, we don't want to cover you at all. We decline to cover you, which means you stick with what you've got and you look at plan B on making sure that the shortfalls are covered. In between best case, worst case scenario, there's a couple of different things that can happen. The insurance company can put loadings on, they can put exclusions on, or they can do a combination of the two. So what is a loading? A loading is where the insurance company looks at your risk profile and says, for the typical person in your risk situation, you are a little bit of a higher risk. You might have a high cholesterol, you might have a high blood pressure, or whatever the extra risk is that you have. Your BMI is too high, you're a little bit overweight. They can then say, instead of charging you X, we're going to charge you 10 or 20 or 50% more for the cover. That is called a loading. An exclusion is if you already had a pre-existing condition. So they will come back and they will say, listen, we will cover you, but you have had 3 back operations. So therefore, we are excluding your back for this cover, which means that if something happens and that pre-existing condition deteriorates to such an extent that you become disabled as a result of it, they will not pay out that claim. But when there is an exclusion, it doesn't mean that if something completely unrelated to the pre-existing condition happens, that the insurance company won't pay out. Let's say, for example, you've had 3 back operations and they excluded your back. And then you get into a hijacking and you get shot, and as a result of that shooting incident, you are paralyzed. The insurance company will still entertain that claim because it wasn't directly related to the previous or the pre-existing condition. So just make sure that you understand, if there's an exclusion or a loading, that you understand exactly what these things mean to you. Don't just accept what the advisor tells you. Also, once you have applied and there is a counteroffer letter, your advisor has to sit with you and still look at your portfolio and see, does the move still make sense? Because sometimes the move doesn't make sense after the new insurance company has come back with the counteroffer letter. Because it might be that on your existing policy, your back is still covered because the accident or the injury happened after the inception of that, where on the new one, it won't be covered. In that situation, it would be better for you to rather keep what you've got. So this is something that you must really discuss with your advisor. Don't just trust and accept what they tell you. Ask the questions. Guys, that's something I want to really reiterate. Ask questions. If you don't understand, keep asking. If your advisor can't explain it to you in such a way that you understand it, then find somebody else. Because the advisor's job is to explain things so that you can understand it, that you can see and be empowered to make decisions for yourself, not to tell you what to do. That is not his job. His job is to empower you to make decisions for yourself. Okay. So things to look out for when an advisor is trying to sell you cheaper or better insurance only. So you sometimes get advisors and you'll get this feeling that all they are focused on is trying to sell me something cheaper, or in their mind something better. So there's 2 things there that's very important to look at. Is one of the things you must understand is that most of the insurance companies' products are very, very, very similar, because first and foremost, they are regulated by the same rules and regulations, and secondly, they are mostly underwritten by the same reinsurance companies. Goodness gracious, it's been a long morning. Reinsurance companies. So it is very similar, but about 90 to 95% of the risk products out there in the market is very, very similar. So if an advisor comes and he starts telling you all these things that the new company is doing better than the old company, it's good for you to ask these questions from your old company to make sure that it is actually that much difference. Because what happens is the guys all fight around this 5% at the top. For me, it is important to get the right cover for catastrophic events. If you hit your thumb with a hammer, don't phone me and say you want to claim for your disability. We don't cater for that. But if you get into a car accident, you're paralyzed from the neck down, it's a catastrophic event, I can guarantee you will have the right cover to make sure that your life can continue. So what typically happens is all these guys fight on that 5 or 10%. Oh, but if you hit your thumb with a hammer, we will pay out 5%, and this other company doesn't pay out anything, therefore we are better than them. Guys, focus on why you are taking out this cover. You are taking out disability cover in the event that you lose your ability to earn and generate an income, not to create a claim because you bumped your toe. That is not the purpose of it. So keep your eyes on the ball. Don't get sidetracked by all of these bells and whistles and small things that the one does and the other doesn't. Look at your core first. Once it does your core, and you know this is the best cover for you, focusing on the core why you need this, then you can start looking at all the other things. But the core needs to be sorted out first. Secondly, when you look at cheaper insurance, there's a couple of things that people use to manipulate the premiums. The first one is they make the cover accelerated benefits instead of standalone benefits. So they show you that you have the same cover or even a little bit more cover for the same premium. But what they don't explain is that the new cover is accelerated benefits, not standalone benefits. The moment you do that, it is cheaper, but the benefits aren't the same. You are not adequately covered if you are just have accelerated benefits. The second thing they do, they would manipulate the compulsory increases on your policy. So it might be a little bit cheaper immediately, but in 2 years, 3 years, 4 years time, it becomes way more expensive because it becomes more expensive faster than your existing policy. So look at that. Another thing that I often see happen is the way that advisors put on your occupation and your duty split on a quote. So you might be, this is a specific example. I had a client. The client was a roofer. He's a building contractor. He does roofs. And he gets into the roof and actually builds roofs for houses and offices. And an advisor came to see him, show him this cheap premium that he's going to get. And when I looked at the quote, that advisor put him on as a manager with 100% admin work. And then he increased his qualification from matric, which the client had, up to a 4-year degree. So that put the client in a completely different risk category, which gave him a lesser premium. But if the client then signs it, that becomes non-disclosure. So when the client has a claim, the insurance company will look at that and say, but this is not the risk we underwrote, which means that they can either repudiate that claim completely, or they can say, well, for what you were paying, we were only going to give you this and not what you actually had on your policy, and only pay out the lower amount. So guys, those are the kind of things that you have to look at when people come with these, this is better or this is cheaper. Another thing that I get a lot is, but if I cancel or if I move my risk, am I not losing the cash value in this risk policy? Guys, a risk policy doesn't build up a cash value. Your risk policy, you pay, call it what if money. It is money that you pay to a third party for in case something happens to you. It doesn't build up a cash value. It doesn't come back to you unless one of those eventualities happen. So how I explain it, and I think I did do it in a previous show as well, it's almost like a gambling arrangement where you come in the beginning of the month, you sit on the table with the insurance company, you say, listen, I think I'm going to die this month. So I'm willing to bet 500 Rand this month that I'm going to die. But if I do die, you, Mr. Insurance Company, will give me 3 million Rand, or my estate 3 million Rand. Are you willing to take that bet? The insurance company then goes through their actuaries. They see that you're not going to stay 18 till you die. And then they come back and they say, okay, great, we will take that bet. You then put your money on the table. They put their 3 million Rand on the table. And at the end of the month, if you haven't died, they take your 500 Rand and they keep it. Then they go, okay, so what about next month? You want to take that bet again next month? And you say, yep, this month I'm going to die. You put your 500 Rand on the table again. They put their 3 million on the table. And if you don't die, they take your 500. It is gone. That is the gambling arrangement. At some point, you are going to pass away. And what then happens is you take, or your estate takes, the 3 million and keep their 500. So it is a gambling arrangement. It doesn't build up a cash value. It doesn't matter what the marketing people are trying to sell you on cashbacks and bonuses and all of that. So let's quickly talk about cashbacks and bonuses. A lot of these companies have jumped on the bandwagon around cashbacks. Oh, we can give you 20% of the premiums you paid back after 5 years, or we will be able to pay you all your premiums back after 15 years. Guys, all of those are a gimmick. What happens is you pay more, so sometimes up to 30%. The company that offers to pay back all your premiums in 15 years is 30% more. So instead of paying 1,000 Rand a month, you will be paying 1,300 Rand per month. So you pay 300 Rand a month more for the same cover. And then if you follow all their rules, they will give your own money back to you after 15 years. Does that make sense? So in that 15 years, if you have a claim, that 300 Rand is gone. If you pass away, that 300 Rand is gone. If you cancel your policy, that 300 Rand is gone. If you reduce your policy, you're not going to get back the same amount. Everything is linked to what you do in your risk, and your risk profile doesn't stay the same throughout your life. You want to have your risk disconnected from your investment. You don't want these two connected, because the amount of life cover you need now and the amount of life cover you'd need when you are 60 will not be the same. So what do these companies do? They link your investment or your retirement bonus or whatever they want to call it to your risk cover. So now you are at age 60, you can't afford 6 or 7 million life cover anymore, firstly, and secondly, you don't need it anymore. But now if you cancel it or you reduce it, your investment portion, your retirement portion reduces accordingly. Guys, if you want to do risk, do it on risk. You pay that money for in case. If it doesn't happen, so be it. Next month you are covered again. You don't worry about investment value. That's why when you look at your risk, you want to spend as little money as possible on risk by looking at it practically. And then the second, if you want to then invest the balance, you invest it in a specific investment that has got nothing to do with your risk. So that if you want to change your risk, it has no effect on your investment and vice versa. So don't get caught up in cashbacks and bonuses. When you are approached by an advisor, also be very careful. Ask questions. Don't be scared to ask questions. Like I said earlier, if they can't explain, or he or she can't explain it so that you understand it, get somebody who can. Make sure that they focused on what you need and not on just what you've got. You'll very quickly realize when you meet with an advisor if they are completely focused on only what you have, instead of focusing on what you need first. Are they asking you questions around the expenses that you need covered, the assets and liabilities, the debt that needs to be paid? Are they asking you these questions, or are they just focused on how much are you paying with the insurance company you are with now? And my insurance company pays this better than that. Once they move to there, they're trying to sell you a product. If they focused on what you need, then they are there to advise you. The other question is you need to be attentive of or aware of is, are they focused on finding solutions for your problems, or are they trying to sell their solution to you? So are they working with you? Are they asking you questions, getting a decision from you, adapting the plan so that it fits your profile? Or do they come and sit with you with a plan already worked out, and all they're doing is trying to sell you the plan that they have planned or they've got prepared for you? The first one is what you want. You want an advisor that works with you, that adapts on the fly, sits with you and say, well, if we change this, we can reduce that. That is what you want. You don't want the person who comes there with a very nice looking folder with everything printed in color, but that's what he sells you. He doesn't have any ability to plan or adapt. So guys, those are a few things that you can keep in mind. If you have any questions regarding your risk cover, if you are unsure, if you want to find out, you are welcome to contact us to have a risk specialist meet with you for a free risk assessment. So if you're a listener, you will qualify for a free risk assessment. You are welcome to give us a call at our office at 087-809-0603. Or you can email info@retirehappy.co.za, and all you can put on there is that you were listening to Berg Studio and you would like to chat with one of our risk specialists. Their focus is to look at what you need, not what have you got. They will first ask you the questions about what needs to be covered, what needs to be looked at, before they even start looking at what you have.
Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
Hi guys, Lourens here. Thanks for watching this video. I hope you found it informative and you got some benefit out of it. Please add in the comments any questions you might have or any other topics that you would like me to talk about. Please subscribe to our channel, hit the bell button so that you can get notified of any new videos that we post so you don't miss anything. Thanks guys, see you around.